Hello everyone, I'm Xin Hong from Philip Capital Management. In short, you can call, and to be more relevant to the products that we are offering, you can call us Philip Funds. Sorry. Okay. So I'm from the business development team, and it take care of the sales and marketing. So before we dive into the topic we are going to talk about today, which is a China market, let me have a brief introduction about our company. Next slide, please. Okay, so Philip Funds was incorporated in 1999, and we are the asset management arm of Philip Capital Group. Currently, we are managing approximately USD 8.5 billion in assets globally. That's actually give us a lot of room. We are one of the largest non-bank backed asset manager in Singapore. Actually, that gives us a lot of room for creativity for the structuring the products. Next one. So over the year, we have expanded our network and offices in 8 countries, including London, Hong Kong, Southeast Asia. We have Thailand, Malaysia, Indonesia, as well as Australia, Turkey, and India. Actually, the network provides us with valuable access to local information and market data, as our investment team will share their assets and ideas regularly. This is something very valuable, as you are not only invest into the fund managed locally in Singapore, but also tapping into experts, the asset managers that are seated overseas. So currently we have 7 unit trusts and 7 exchange traded funds. So today we will focus on ETF, invest into the 50 leading China companies. Over to you, Teck Ling.
Hello. Good evening, everybody. Thanks for tuning in. Thanks, Tiger, for the invitation. My name is Teck Ling, and I'm from the investment team of Philip Capital Management, which Xin Hong has just introduced. So basically, for us, we started our first ETF in 2016. So today we have a suite of ETFs that Xin Hong has shown you, numbering about 8 or 9 already. And our most recent product is actually the Philip China Universal MSCI China A50 ETF. Today, I will be talking to you about this ETF, but before that, I think it will be very useful to give you guys an overview of the China economy today, right? Recent developments, and also why China A shares are attractive, or you should consider that as part of your long-term portfolio, right? A shares, meaning the China domestic market shares. So a lot of you probably would be more familiar with the Hong Kong market China shares like Alibaba, Tencent, right? But in fact, these overseas listed ones form just a minority of the total China shares market or China companies. The majority is actually on the domestic A shares market. So I will talk to you about that, and also through the ETF, how you can access these markets. Okay. So we'll cover about 40 minutes, and then I'll leave some time for questions and answers after that. Right. So current overview of China. Firstly, I think it's worth pointing out that the China problems, right? Of course, China has been a multi-decade success story. And in only recent times has been the problems been focused on by the newspapers, the press, right? Analysts. And now I think after several years, it's probably quite well understood in a sense. For example, everybody knows that there's property sector troubles in China. There's a lot of debt problems, especially with the private developers. Some of them actually have gone bankrupt because they're unable to pay up. The most well-known one is Evergrande, of course, right? And there are some other smaller ones as well, right? And this is definitely a structural problem. There's no denying it. Secondly, slowing economy. So associated with that is deflation and slowing economic growth. Now, deflation means it's basically the opposite of inflation, right? Where you are facing the issue of inflation in many developed market economies because the prices are going up too fast. In China, actually, the opposite is happening in the sense that the prices are stagnant. In fact, while the so-called consumer prices are growing slightly up, in fact, the wholesale prices, that means the prices of products that are just out of the factory gate, there's actual deflation, meaning that it's actually year on year going down in price. Okay, and that's associated with the slow economy. Thirdly, geopolitical tensions with the West, right? All eyes now are on the US election, presidential election coming up in November. And depending on who wins, either whether Kamala Harris wins or Donald Trump wins, I think the antagonism from America towards China is still there, but the general consensus is that Donald Trump is going to be much more tariff happy in terms of imposing trade barriers against China. When you look at the economy generally, economic growth, you tend to break them down into a few parts, right? The three of the main ones that I'll talk about: fixed asset investments, consumption, and exports, right? These are seen as the three main economic drivers of China, economic growth drivers of China, right? What does fixed asset investment refer to? Basically, that's referring to the overall construction and investment into fixed assets and infrastructure, right? Including factories, right? For many years, that has been one of the key drivers of China's growth, building bridges and infrastructure, building high-speed railways, building factories, and of course, building residential and commercial properties, right? And here I'm showing the breakdown of the FAI, fixed asset investments. The blue line basically shows the year-on-year growth for each of the years shown below: 2018, 19, 20, 21, 22, 23, and part of 2024, right? And this blue line in turn is broken down into the sub-segments under FAI, which is broadly speaking, it would be real estate, infrastructure, and factories under manufacture. Basically, you can see that where these three components of the fixed asset investments in 2018 and 2019 were actually rather balanced in contributing to the overall FAI in blue. In recent years, you can see that the light brown one, which is the real estate, that has turned negative. It's turned negative since 2022. And it continues to be negative today, right? Because obviously that is because of the real estate problems in China now. But look at the other contributors. The manufacturing as well as the infrastructure construction, that is actually helping to support the overall FAI in blue, such that when you look at the overall FAI, the blue line, the year-on-year growth is still positive in 2023 and so far in 2024, probably around 5% or so, or maybe slightly below 5% year-on-year, right? So that is basically reflecting what is shown in the title. Basically, the FAI, fixed asset investments, is showing a transition from real estate to a greater focus on infrastructure and manufacturing. And of course, where is some of this infrastructure budget coming from? Is coming from the general, the central government and the regional governments, right? So when you say that, fiscal stimulus, that's what people always look for nowadays. But in fact, actually, the government is spending quite a bit over the past few years, really, to build infrastructure and attract factory investments to offset the impact of the negative real estate growth. Secondly, consumption. domestic consumption is increasingly going to be a big factor going forward in contributing to China's growth. In the past, China used to be more about exports, right? But in recent years, of course, the government under China's President Xi Jinping, they have been talking more about a so-called a dual circulation economy. So dual circulation meaning that not just growth contributed by exports and manufacturing, but also growth contributed by the internal circulation of domestic consumption, right? So that's what they mean by a dual circulation. And domestic consumption has been relatively resilient, although I would have to say that retail sales have been rather dampened over the past few months or the one year or so. Retail sales year on year has been it used to be in the trend growth for about high single digits year on year. So nowadays the retail sales growth is in the region of about maybe 5%, 4%. So it is about half that of the long-term trend, right? But still positive, right? So I think definitely while its resilience is on the lower side of the long-term growth, right? The income of residents definitely plays a big part in how the retail sales, the ability to consume, how the capacity to consume is of course dependent on the income of residents. And here so far you can see that the disposable income per capita, it is not growing as fast as previous years, but still positive year on year, right? And if you look at this year's Chinese New Year travel rush, right? That's the third chart. You can see that the travel trend has been quite strong, right? Not just versus 2023 year on year, but also versus 2019 pre-COVID levels. So in fact, currently, just looking at the Spring Festival, the Chinese New Year travel so far this year, that has actually surpassed pre-COVID trends, right? So the dual circulation potential is there. The domestic consumption potential is there. I will go a bit more into detail later regarding the China government's stimulus efforts in recent months. Thirdly, manufacturing. Manufacturing actually has been one of the bright spots in the Chinese economy. So if you look at the export volume on the left-hand chart, export volume year-on-year growth, 2024, the gray chart shows that the export volume has been growing year on year, right? You can see clearly almost like 15-20% year on year. And China's, on the right hand side, China's export monthly year on year, that is shown in the light brown line on the right. So that's also positive. So in fact, the narrative is that China's exports has been actually around the long-term trend, right? So the long-term trend for China's exports has been around 7 to 8% year on year. That has actually been the case for much of 2024 so far. Until recently, I guess, which is not updated in this chart, right? Because it was the most recent data that we just saw. The most recent data is that the exports from China has also come down. Still growth year on year, but basically the pace of growth has been decelerating. So it's more like 4-5% year on year already. So also China's exports is starting to come down, right? So all this rather a mixed picture, right? It basically shows that, in summary, that China's economy is basically not as fast as the long-term trend over the past 2 or 3 decades. And probably that is a challenge for the China government because they do have a 2024 GDP growth target of 5%. And they will probably find it a challenge to reach the target because right now it's below the 5% year-on-year mark so far this year. So this chart basically gives you a sense of the China exports towards the various regions, right? 2017 in gray, and 2023, right? So you can see that, in fact, China's exports to the West, it's not just to the West, not just to US and Europe, but also to ASEAN, Latin America, Japan, Korea, right? And you can see clearly that the other thing is that the exports to the US as an export destination has been coming down, right, from 2017 to 2023, right? So now it's below 15% of total, right? That gives you an indication of, the relative importance of the various regions for China as for its exports, right? So it's not entirely dependent on the US, of course, right? Now, I was mentioning that basically China, it's going to be a challenge for 2024 5% GDP growth target. That is the reason why in recent months, in fact, in 2024, the central government and the central bank have been increasingly active. This slide is basically showing what was the policies introduced by the central government and the central bank in the early part of 2024. Right. So as you can see, there's a lot of measures already at that time. And if you remember the China stock index, there was a rally of about 20% earlier this year. Not recently, but in around February, March, right? And basically, it was in response to some of these stimulus. But soon after, it dampened down, right? And so you will remember that there is a second round in the late September, early October, right? Which is shown in this slide. And it is generally agreed among analysts that the September to October measures by the central bank and the central government, right? There was a flurry of press releases, first by the central bank, and then after that, the central CSRs, the central government as well, right? The Minister of Finance and so on. And this is a summary of the recent so-called the recent announcements or policy announcements by these two parties. Monetary policy, basically the central bank cuts the bank's reserve requirement ratios, the repo rates, the lending rates. So basically it makes it much cheaper for people to borrow, and it makes it much easier for banks to lend out the loans. Property sector support. So they have cut the down payment ratios. They have increased lending programs for affordable housing. Market support. So they have increased the tier 1 capital at 6 major banks. They have actually made available lending facilities to the securities firms and various institutional investors, or even listed firms themselves. They've made available lending facilities for these institutions to directly buy their own stocks, to buy stocks on the open market, right? And lastly, the fiscal policy, which was the one that was a bit disappointing, right? The first three were actually from the central bank. The fiscal policy was from the China central government. And basically people were expecting some kind of bazooka, big number, several multi-trillion fiscal stimulus. Well, that didn't really exactly come out, but I think there were some measures by the government they have come out to say that they will increase measures to support local governments, boost their finances, and digest the unsold housing inventory. And they are also planning to issue special government bonds. Sovereign bonds is government bonds. And they have said that it's going to be multi-trillion yuan in size. So to issue these bonds, meaning that they will increase the borrowing of money from the open market. And what is that going to be spent on? Basically, it's going to be spent on government programs to inject funds into the market. So they have not gone into details, which is what disappointed the market. But when you look at the fact that they are planning to issue multi-trillion yuan sovereign bonds, you know that they will be doing more than usual to boost the economy on the fiscal side. So in late September, I think if I were to show this slide, that whatever it takes would not have a question mark, the title of this slide. And basically now, because the narrative now is that people are wondering if the central government will really do whatever it takes to boost the economy. Right? That's where the question mark is here. Right? It remains to be seen. So probably the next major meeting is the one by the central government. They have a big meeting around November, right? Maybe they will give more details about the fiscal policy spending going forward, right? So as you can see, basically the big moves in September, October, it centers on a few things in summary. How would I summarize it? Basically, it centers on supporting the capital markets. It centers on supporting consumption. It centers on supporting the local governments and stabilizing the real estate market, right? So it is a much more demand-centric set of approach this time round, where previously I think the government has been talking more about on the supply side, right? Quality growth, innovation, getting the companies to increase their quality of their manufacturers and their technology, right? So that was more on the supply side. But in 2024, and especially in the September-October measures, you can see that a lot of the policies are focusing more on the demand side. So I think a bright spot that you can see from this is that really, I think the central government is recognizing the problem. You cannot get the economy to recover without getting some confidence in consumption. And you cannot do that when the real estate market is weak. You cannot do that when people are not in the mood to consume. And even they are looking at the wealth effects. Basically, by boosting the capital markets, people will have a better sense of consumer confidence, and they will be more ready to consume. Right. So that is the possible takeaway from the recent measures. Right. No big bazooka. Right. But possibly, if you were to look at it, possibly there may be a turning point. And the next slide that I want to show is that policies can have a major impact, especially for the China market. You might even say that the China domestic market, the domestic stock market is basically quite a policy-driven market. Because if you look at the various big rallies over the past decade or so, you can see that they were all associated with the launch of certain major policies, right? 2014 to 2015, there was launch of the Stock Connect, which enables foreign investors to buy through the Hong Kong market into China mainland shares. 2016 to 17, there was a big increase in central and local government borrowing to 10% of GDP to increase spending. Because if you remember, in late 2015, there was a the emerging markets, especially China, were in the doldrums, and then there was a growth scare during that time, right? And early 2020, of course, there was the COVID, right? And there was a multi-trillion yuan additional stimulus spending from the government to support the economy. So all these were associated with big rebounds in the mainland China index, which in this case we use as the China A50 index. Another thing to note, this is the Bank of America actually does a regular survey among institutional investors and hedge funds to survey which are the most popular or so-called crowded trades among these institutional or fund investors. So as of the most recent September survey, I think short China equities was actually the second most popular trade after the long Magnificent Seven US stocks, right? So fully 19% of investors felt that the most crowded trade as of September was short China equities. And that basically means that it was generally acknowledged that most people were probably very negative on China equities at that point. I would say that probably this survey was done before the round of policies was announced by the central bank in China and the government, right? But what you can appreciate is basically that, there is a lot of ground to cover. Should people start to become more positive, right? Then they will increase the allocation. There is a lot of ground to cover from there, from a very low base. Okay, so I just go to the next one, which I will talk a bit faster. Okay, the case for China shares, right? The case for China shares, especially A shares, which is the domestic shares. Well, some of these are long-term structural trends, right? So, for example, China today, if you look at the GDP, just nominal GDP is the second largest in the world. But if you adjust that for purchasing power, the GDP for China is actually the largest in the world, which is the one in red, right? So it's already surpassed the US in purchasing power adjusted GDP since 2016. Purchasing power adjusted means that you adjust the GDP to reflect the amount of actual amount of goods that $1 of the GDP can actually purchase within the economy itself, right? So it really reflects the so-called the purchasing power of per unit of GDP, right? So when you adjust for that, China actually has the largest purchasing power in the world, so to speak. Size of the stock market, secondly, you can see that if you look at the global stock markets values, that means basically the total value of the stocks listed in each of the stock markets as shown. The top 10 stock markets in the world, actually China has two of them, the two domestic exchanges, Shanghai and Shenzhen, right? And if you were to also include Hong Kong Exchange inside, then in fact China has 3 among the world's top 10. And the second point to note on the right is basically, if you were to look at this total stock market value and you divide that by the country's GDP, China is still at a relatively early stage of development because compared to the US, which is currently, that number is close to 200% already, meaning that the stock market is really quite highly valued versus the GDP. Meanwhile, in China, that number is more like 70-80%, right? So it may grow either from the valuation of the existing companies listed or from new listings, of course, going forward. R&D. So R&D, here I show 2 charts. One is the input, one is the output. Right? On the left-hand side, the input, you can see that China R&D spending is actually comparable to the US already. Right? That's very clear, right? In billions of dollars terms, it's comparable. These two are easily the 2 biggest spending on R&D in the world. Secondly, on the output, you can see that in terms of the high quality science papers, the ones from China, the share from China actually is coming to nearly 50%, the one in red. And that's comparable to countries like the US and the EU, right? If you were to look at the stock market perspective, or on an overall portfolio perspective, what is the attractiveness of China A shares? I think this chart here gives a good perspective. Basically, China's equity index has low correlation with other main markets. So here the main markets that's shown is the US S&P, FTSE in the UK, CAC in France, DAX in Germany, Nikkei in Japan, right? And also the last one compares against the MSCI Emerging Markets Asia. You can see on the last line, MSCI China A shares, the index itself actually has low correlation against all the other major markets mainly, right? correlation against S&P, for example, is just 14%. If it's perfect correlation, it's 100%, of course. So anything below 30% correlation is considered very low correlation, right? So you can see that China's A shares has generally got low correlation with the other major markets. What does that mean? Basically, it offers good portfolio diversification. When the other markets go up, China may or may not go up. But when the other markets go down, right, China also may or may not go down, right? It contrasts that with a market like Japan, right? Japan or Europe or US, they have high correlation with each other. So if you have just these markets inside your stock portfolio, they don't sort of diversify each other. They all move to the same rhythm, right? So if you want to consider something that helps to diversify your portfolio, right? China A shares may be something that you want to consider, right? Versus the other peer markets, such as the ones that I just described, the US, Japan, London, France, and so on, you can see that China's domestic markets, in terms of PE ratios, is actually among the lowest in the world, right, amongst the major markets. If you look at the two lines, MSCI China A shares, MSCI China A50 Connect. So basically, they're trading around 10 to 12 times PE, right? So contrast that to the US or Japan, trading between 20 to 25 times PE, right? And if you were to look at the China's equities market compared against itself in historical comparison, right? So here, the thick red line basically shows the China A50 shares index, right? And each of these lines basically shows, each of the lighter lines here basically shows the PE bands. So 9 times, 12 times, 15 times, 18 times. So right now, the index is around the 12 times mark, right? Which is because it's basically touching the light brown 12 times PE ratio line, right? So it's around here. It is not demanding, right? It is trading at a relatively low valuation level. In fact, before the recent rally, right? So China was trading more at like around 10 times, right? 10 times or so. Then there was the rally, so now it's not trading more around like 12 times or so. Okay? But definitely it's not trading at excessive valuations like 15 times or 18 times. So versus itself and its history, it is also trading at quite affordable valuations. Now I look at the China's stimulus, right? So first of all, I just want to highlight that China's forex reserves is actually the world leader at over $3 trillion, right? Secondly, on the bottom, you can see that China's general government debt as a percentage of its GDP, that is also relatively low compared to other major economies at 83% of GDP, right? So that's the capacity for stimulus. So basically, China's economy, I think you get a good sense that it has rather resilient fundamentals, right? And the long-term trend is basically seeing that as a major exposure to equities. I think it is something that you can consider for China. The next thing I just want to expand upon is why A shares, right? Why China's domestic market? Well, you can see on the right-hand side, the pie chart. If you were to focus on Hong Kong to get exposure to China, in fact, more than 3/4 of China's total equity market value is inside the domestic A shares market, listed on Shanghai or listed on Shenzhen. Hong Kong listed H shares or tech companies, they just form maybe 1/4 of the total, if you consider. And then those listed in the US, even smaller, 5% of total. So you may be familiar with Tencent and Alibaba, right, on the Hong Kong exchange. But in fact, the major companies listed in Shenzhen and Shanghai, they are the ones that form the bigger chunk, much bigger chunk of the total. A shares offer good exposure to the overall domestic economy as a result. There are over 5,000 shares listed on the China A shares market in Shenzhen and Shanghai combined, right? And basically, a lot of them, the big companies, are beneficiaries of China's economic transformation. That will include like the renewable energy, high-end manufacturing, consumer goods, healthcare, right? Okay, and that is the next slide. Basically shows the performance track record over the last 10 years. So I can talk all I want, but the performance, actually, the long-term performance illustrates this much more clearly. If you look at the various indices by MSCI that track the China market, the top performer is actually the China A shares. The red line is the MSCI China A50, right? Over 10 years from 2014 to 2023, the accumulated return is 80.5%. If you were to look at the poorest performing China-related indexes, it's the two in gray, which is MSCI China All Shares, MSCI China. Now, what is MSCI China All Shares and MSCI China? Basically, it doesn't include just domestic China shares, but it also includes China shares listed in Hong Kong, China shares listed in US, right? If you were to take all this into account, the US and China and Hong Kong listed China shares actually drags down the total, such that if you invested into such an index, you actually end up with nothing over the last 10 years, right? 3.1%, 40.8%, right? It appears in comparison if you had just invested purely into China A shares. And this is what brings us to what we are going to talk about today, which is the MSCI China A50 Connect Index, right? This is an ETF that was introduced by us together with China Universal, our mainland partner. We launched it in March this year, right? And what this ETF does is it is self-explanatory in the index name. It tracks the MSCI China A50. So basically, focus on China A shares, domestic shares listed on Shanghai and Shenzhen only, and it tracks the leading 50 companies, right? How is this ETF structured? So basically, we have this Singapore-listed Philip China Universal A50 Connect ETF. Basically, it fits entirely into the Shanghai-listed China Master ETF by China Universal. So this Master ETF by China Universal is called China Universal MSCI China A50. So it's the same index, obviously. And it's been running since 2021. It's over $1 billion in size, AUM, right? So basically, our Singapore SGX ETF is basically a feeder into this ETF. So in this way, we minimize transaction costs because we just buy one single position, which is this Master ETF, right? Which the Master ETF, of course, in turn, it will invest into the 50 constituents. And this is riding on the ETF link that was formalized by MAS and SGX together with the China mainland authorities, right? So today, in the past, it used to be that you cannot invest into China A shares easily. But today, with this ETF link, you can actually invest into ETFs such as ours that buy into China A shares for you. Right. Some attractiveness or features about this product. It has all the good points about ETFs being rules-based and transparent, and it is a convenient way to invest into China's A shares market. In one click, you can get access to 50 leading stocks on the exchange, right? And I just want to talk a bit about this benchmark that is tracking, which is the MSCI China A50. So for those of you who are not familiar with MSCI, basically they are one of the world's leading index providers, right? MSCI FTSE, these are the two key ones globally. And MSCI China, so MSCI, they constructed this index with a view to ensuring that it has firstly, exposure to leading companies. So that's why it's 50 leading companies. And secondly, it looks to ensure that there is balanced representation across the key sectors in China, right? So take a look at how it's constructed. You see the chart on the bottom. A50 Connect, the parent index is starting from China, MSCI China A index. So basically all the stocks within the universe of China's A shares in Shenzhen and Shanghai. Then MSCI, what they do is that they ensure that each of the 11 key sectors, such as industrials, consumer discretionary, consumer staples, technology, basic materials, utilities, all these 11 sectors, the index picks up at least 2 of the leaders from each of these 11 sectors. So 2 times 11, so you will have 22 companies that represent each of these 11 sectors. Then finally, to make up the remaining 28 to make up 50, right? So then MSCI picks the remaining 28 largest market value stocks, right? So in this way, basically, MSCI ensures that the index has good representation across the various key sectors, 11 key sectors. So you can see on this, as of September 2024, there's relatively balanced sector exposure across the various sectors. So you don't have like finance or technology taking up like oversized part of the overall index. In fact, what you see is that actually the biggest sector is just around 20% of the total. Each of the other key sectors is also represented within this index. At the same time, the sector leaders are represented because the methodology for this index is to focus on the biggest companies, right? So you will see some of the very familiar names, right? CATL, BYD is there, right? And Guizhou Maotai, some of you all might know it, is actually the spirits company in mainland China. And to give you more insight, basically, the top 10 stocks, for example, which actually combine to make up nearly 50% of the total index. They are all leaders, mainland China leaders in each of their respective sectors, right? Some you may not be that familiar, right? Zijin Mining is actually a global leader in many minerals such as zinc, such as copper, such as gold, right? Wanhua is a domestic leader in chemicals with very resilient gross margins. Luxshare Precision is a big components manufacturer for Apple on the mainland. Foxconn Industrial Internet focuses on making smart manufacturing equipment for factories, right? And it's actually a JV between Foxconn from China and a mainland partner. Yangtze Power owns one of its big projects is the Three Gorges Dam, one of the biggest hydropower dams in the world, right? Hygon, yeah, this is a new addition to the top 10, right? Basically, it has been doing very well. It is actually a leader in semiconductors and is going to benefit from China's ban on some of these Western semiconductor designers. Hygon is a fabless semicon company. So basically, they do design of semicon circuits. So they're expected to benefit from some of these domestic focus from the government. And to compare the MSCI China A50 versus other indexes, you can see that it has it is much more well balanced. So that's one thing. The MSCI China A50 is basically the one in dark red on these charts. So you can see that it's much more well balanced compared to other indexes that track China, such as FTSE A50. So FTSE also has another one that tracks the top stocks in China, the top 50 stocks. There's SSE 50, which also tracks the top some of the leading companies in mainland China. CSI 300, CSI A50, right? So all these indexes all look to track major companies listed in mainland China. But the MSCI China A50, it is probably more well balanced. So for example, finance on the left-hand side, you can see that it has got much lower representation compared to other indexes such as FTSE A50, such as SSE 50, right? And it also has good representation in the IT sector, right? Information technology, it is among the highest, 14.6%, right? Compared to some of the other indexes that track mainland China shares. Right? So the key, so this is a deliberate design of the index provider MSCI, right? So it is trying to have a balanced weight towards old economy and new economy. Right? And this is a chart that we just saw just now, right? The long-term performance of this index, which is in red versus some of the other indexes, right? Our performance generally over the last 10 years. Now, I'll just end off with this chart, right? This chart gives you a sense of the overall arc of history, how China's GDP as a function of, as a share of the world's global GDP, how it has evolved from the year 1 AD until 2017, right? So China's share is in red, right? As you can see here. China used to be a big part of the world economy, occupying up to 30 or 40% of the global economy by GDP. Up till 19,000 onwards, then it started shrinking a lot, right? As you can see. So much of the 20th century, it was actually a minor part of the world economy. But today, it is coming right back into to claim its share of global GDP is growing fast. So it is definitely not a case that China is a one-shot wonder in this sense. But if you appreciate that through the lens of history, there may be more to go, right? And also this one is to give you a sense of where we are now. Of course, this shows our ETF, the price of the ETF since listing in March this year, right? The market price since launch, it was listed at $1, right? It actually dipped below $1. And then after that, in late September to early October, it shot up to as high as 135 to nearly 140, right? That was the period when they announced the stimulus recently. So all of y'all probably will be aware. And since then, it has retraced quite a fair bit due to the disappointment from the market that the stimulus the fiscal stimulus especially was not as large as expected, right? So it's corrected back to around 110 level, right? Yeah, so this is to let you appreciate where we are now today, okay? And lastly, this is some of the things that if you want to find it on the SGX, the ticker is MCN, right? And a recap of what it tries to do, this ETF tries to do is to track the 50 leading stocks in China's A-shares market. So with that, I thank your attention and happy to take any questions from here.
Thank you, Teck Ling, for your excellent sharing. So please feel free to type your question in the chat since today we have opportunities to talk our Deputy Chief Investment Officer. So Teck Ling, actually there's a question for you. From the audience says, is there any extra cost or loss when we buy ETFs with Chinese teams in foreign currencies?
Okay. So basically this ETF that we are listed here is in Singapore dollars, right? Let me just it's in Singapore dollars. This ticker is MCN is trading in Singapore dollars. Is there any additional cost? So basically what happens is that the market makers, there are the market makers for this ETF. Basically, they are providing a bid price and ask price. So you can, if you want to buy, you take it at the ask price. If you want to sell, you take it at the bid. Typically, it's like that, right? The market makers actually, what they do is they take the rightful value of this index, they convert it from Chinese yuan to Sing dollars at around the prevailing market rate. Then they quote it in Sing dollar terms, right? So naturally, as with all shares and securities and ETFs, there is a spread when the market maker is quoting on the exchange. There's a bid and an ask, right? So there's a spread between the bid and the ask. So a bit of this is reflecting the exchange rate spread between when you convert it from Chinese yuan to Sing dollars. So basically that is what it is. And but what I also want to emphasize is actually the bid-ask spread for our ETF is amongst the lowest of all A-share ETFs listed in Singapore right now. Right? It's currently around, typically if you look at the market for this ETF, the bid and the ask, the spread is around 0.4, 0.5%, which is very tight. It's a relatively tight spread. And the whole idea for this ETF being listed here is for you to be able to buy with your natural Sing dollars to expose yourself to the China mainland market. So the long and short of it is, the market makers actually incorporates the forex, the conversion of the Chinese yuan to Sing dollars into the prices that they offer on the exchange. Right. Okay. So when you buy, you can buy it with your Sing dollars.
Okay, thank you, Teck Ling. So there's another question asked, are Chinese bonds worth buying? Are there Chinese bonds at the bottom of MCN?
Chinese bonds? No, it's all stocks. Is that the question?
Yeah, this is the question.
It's all stocks. Yeah. If you want bonds, you would look at other ETF. Yeah, this is a stock equity ETF.
So if there's no further questions, thank you for joining us today. And if you're interested with our products, you can search MCN from Tiger Broker. And thanks again, Tiger Broker, for inviting us. Okay, see you. Bye-bye.
Thank you.